Wall Street is closed for Tuesday, February 24th, and it was another day where the market's darlings showed some cracks, while a few quieter corners of the tape quietly stole the spotlight. I'm Grant Mercer, this is Storm Stock Solutions, and we're here to bring a little clarity through the chaos of today's session. Let's start with the tone. The story into the close is caution around big tech and stretched valuations. According to MarketWatch's Christine G., Microsoft's stock sell-off has brought it to a technical crossroads we haven't seen in over a decade. Shares are now sitting less than 3% above their 200-week moving average, a level that's acted as long-term support in past cycles. When a mega-cap pillar like Microsoft is that close to a multi-year trend line, traders start asking two questions. Is this a healthy reset within an uptrend, or the start of something more structural? That debate was hanging over the broader tape today. On the upside, there were still pockets of strength. One of the standout names was Constellation Energy. Reporting from Claudia Assis at MarketWatch highlighted that the stock zoomed toward its highest level in nearly 6 weeks, and did it even as management pushed formal yearly guidance out to March. In other words, the market was willing to look through a delayed outlook and focus instead on the broader story. Independent power producers benefiting from tight energy markets and ongoing demand for cleaner baseload power. It's a good reminder that in a valuation-heavy environment, traders are leaning into companies with visible cash flows and durable demand, even if the guidance slide deck isn't quite ready yet. On the flip side, today's risk stories went beyond one company. Mark Hulbert, also at MarketWatch, pointed out that 9 of the 10 most watched valuation indicators for U.S. stocks are now in what he calls sell territory. That doesn't mean the market must tank tomorrow, but it does underscore how extended this cycle has become by historical measures. When you combine that with Microsoft hovering just above a key long-term moving average, it puts a lot more focus on any disappointment, whether it's earnings, guidance, or macro data in the weeks ahead. Valuation becomes a much harsher judge when the numbers are already stretched. Layered on top of that, Isabel Wang's reporting highlighted a fascinating twist in the so-called safety trade. Consumer staples, think discount chains, household products, shampoo makers, have historically been the calm harbor when tech sells off. But with AI jitters shaking confidence in high multiple tech, money has been crowding into those same staples, pushing their valuations up and, ironically, turning them into one of the riskier corners of the market. That's an area to handle with care. When the safe haven gets too popular, it stops being so safe. Beyond prices and valuations, there were some interesting corporate and structural themes that played out today. Charles Passy at MarketWatch wrote about a growing trend of CEOs engaging directly with customers through social platforms, live chats, town halls. Executives pitch it as a way to better understand their businesses, while some corporate watchers see a heavy dose of PR and reputation management. For traders, the takeaway isn't whether the CEO is on X or TikTok. It's that investor perception can increasingly be shaped in real time by how management communicates, not just by what shows up in a quarterly filing. In terms of under-the-radar watchlist stories, there are a few I'm keeping in the background. One is the ongoing debate over wealth, power, and policy. John O. McGinnis argued in MarketWatch that democracy needs billionaires, and that muzzling the wealthy on free speech grounds could backfire. It's a political philosophy piece, but for markets it matters, because public sentiment toward the 1% often precedes shifts in tax policy, regulation, or campaign finance. Things that can reshape sectors from financials to tech over time. Another sleeper is healthcare policy and aging demographics. Jessica Hall reported on a study showing meaningful differences in how traditional Medicare versus Medicare Advantage handle prevention and treatment around strokes. That might sound far from today's closing prices, but it feeds into longer-term questions. How insurers design their plans, how hospitals get reimbursed, and where cost burdens fall. Those pressures can influence managed care stocks, hospital chains, and even medical device demand as we move through the year, and then there's the autonomous driving race. William Gavin noted that Waymo, backed by Alphabet and fresh off a $16 billion funding round, is rolling out commercial operations in 4 more U.S. cities. That's a quiet but important data point. Robotaxis shifting from pilot projects to actual commercial scale. Traders will be watching whether this begins to widen the gap between Alphabet's approach and what competitors like Tesla and Amazon-backed efforts can deliver, and what that might mean for regulatory scrutiny and future revenue streams. Finally, in the real economy, Spirit Airlines popped up with a restructuring story that could matter more over time. As Claudia Assis reported, Spirit has struck a deal with creditors and aims to emerge from bankruptcy as a leaner carrier, less focused purely on ultra-low-cost travelers. That speaks to evolving air travel demand. Consumers still flying, but perhaps trading up in experience or mixing leisure and business in new ways. Airlines, travel platforms, and even credit card reward ecosystems all watch those trends closely. Looking ahead to tomorrow's session, the next pre-market will be all about whether this valuation tension tightens or eases. Traders will be focused on big tech price action, especially Microsoft around that long-term 200-week moving average, and on whether the crowded defensive trades and staples and other perceived safety sectors start to unwind or dig in further. Any new macro headlines, policy chatter, or earnings surprises could act as a spark in what is already a valuation-rich environment. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Stormstock Solutions, I'm Grant Mercer.